For the first time, recession's on the table. We could see a recession in 2022. I did not think this was possible 3 months ago, but here we are now. China's shutting down. We're going to probably have a 10% inflation print in the US coming up in the next month. We have Russia looking like North Korea, and rates are going up. The Fed's going to increase rates 7 times this year. So it is an increased likelihood. What is it, 50-50, that a recession is going to hit this year? The question is, where do we go? What's working? What's not working? Where to hide? Where not to hide? Stick around. We're going to cover that and so much more. Hey everybody, RC Peck here with my weekly update, and we have a lot to cover today. We have to look at interest rates, we have to look at bonds, we have to look at commodities. Now, why do we have to do this? Because these are major asset classes on the planet, and we have to understand where money is flowing into and where money is flowing out of. Is the commodities move over? Is the stock fall over? Or are both of them paused or something else? So I'm going to jump over to the price charts. We're going to look at what's going on in the market. We're going to find out if the market has in fact bottomed or it's just taking a breather. So we're going to cover that and so much more. And look, even if you're not in the market or you don't own bonds or you don't worry about growth stocks, this video is going to help you because it's showing you how to think more like price and less like a scared person reading headlines who doesn't want to lose all their money. So understanding how to read price charts is really important. Okay, let's start with this price chart right here. And let me actually, as I look at this, let's just make it really clean. Let's just clean it up here. So here's ARK Investment, ARK Innovation Fund, Kathy Wood. It's her lead ETF. Now, I want to point some things out that you're going to see over and over in these price charts today. So where my blue lines are, that's the old pre-COVID high. So that happened here in February of 2020. What you're going to see over and over today are buyers coming in, right, where sellers came in back in February of 2020. So look at ARK Innovation here. ARK Innovation has been absolutely, let's just look how much it has fallen. 67%. That means that's close to having to rise. Let's just see how much you would have to rise just to get back to break even. 200% that have to go up just to get back to break even. But what I want to point out is just notice how buyers are coming in right now at the pre-COVID high. Buyers are coming in. And you see this, let's just look at some others. Like here is an ETF for Europe. Same thing, here's the pre-COVID high right here. And buyers came in and bought European stocks right here. That doesn't mean this correction is over. That doesn't mean this correction can't turn into a crash. What it means is buyers came in here. And so what's very likely to happen is the price is going to go back down here. We could probably range this like right here, increase the size of the range, but still that's only about a 5% range. What's very likely to happen is the price is going to go back down and we're going to see if more buyers are coming in. So the market and the world is actually, let's be clear here, the stock market is still getting more unstable, right? Notice this is basically the European stock market. Notice how it totally collapsed below that. That happened before the war. Now that probably said there was a war coming. But if the price of Europe stays below, and let's just call this a price chart of the European, let's call Europe one stock market. That is negative. That is still life being more unstable. And let me be clear here. When a market goes up 8 or 9% in a day, that's signs of instability, not signs of stability. Here is the DAX. So this is the index of Germany. So no currency issue here. And we're seeing the same thing here, right? People came in really late, the bottom blue line, to finally start buying. But yeah, people came in when the price of the German stock market went below pre-COVID highs. Buyers came in. And then we have China, which is just, I don't even know what to say. I mean, could that have been the bottom? Absolutely. That was such a clean out. This is FXI. It is priced in US dollars. And that was an absolute wipeout right there. Let's just zoom out a little bit and look at the past decade here. And you can see that it's a complete mess. Notice how it peaks, sells off, peaks, sells off, at least on this price chart. So we could be seeing a potential bottom or clean out in Chinese stocks because, man, that is a huge clean out. Part of that is China saying they're shutting down. I also think part of that is China siding with Putin, and I think that's going to hurt them long term. The world is voting with their dollars. The West is more united than it has been in decades. Maybe since World War II, the West is really getting united behind Ukraine and really saying this is not okay. I get not putting in a no-fly zone, as that may be an escalation to war, but it is very clear where people are siding in this war, in Putin's war. And I believe China is on the wrong side of history. I believe Russia is turning into North Korea, and then China will turn into Russia. Now, China is much bigger than Russia. It produces more than just energy. But things are shifting very quickly. Do not buy. Some people ask me, should I, buy some individual Russian stocks? Absolutely not. Stay away from Russia. The Russian stock market will probably be closed for a decade. Just stay away from Russia. So the stock markets around the world, they're actually getting more unstable. When you see these huge moves, I know I'm repeating myself, but I want to for clarity, these huge moves higher, that's a sign of instability. Here's the S&P 500. It doesn't look that bad right here. And yes, that could be it. But what I see is a sideways market probably for the next 6 to 12 months. If things change, we'll look at them. Here's the S&P priced in the bond market. So literally what you're looking at is U.S. stock market priced in U.S. bond market units. Now this looks better, right? This is saying, hey, things are actually stabilizing faster. So I will absolutely keep a watch on this. And if it breaks out, if this price chart breaks out, then that's going to be a sign of definite stability in the stock market. So I am going to watch out for that. Let's just quickly look at the European stock market divided by international bonds. So this is troubling here. So this is the European stock market when priced not in dollars, but priced in international bonds. That does not look good. So there's still more instability. Europe still is one of the more unstable stock markets around the planet. And just quickly, let's look at China and more divided by emerging market bonds. So yeah, that could have been the clean out in China. So for right now, the stock market is still, let's call it sideways. It is going sideways. Certainly the US stock market out of all major stock markets is still the place to be. SPY has definitely stabilized. If we quickly look at the NASDAQ's definitely been hit harder, but it has bounced back. It was down as much as 21%. And since that bottom, it has come up 9%, which is just pretty remarkable. So it does have a double top. So right now, the NASDAQ's down a little under 14%, which is pretty amazing how fast it came back. Again, I'd expect sidewaysness for the rest of the year. But again, if we start seeing the stock market when priced in the bond market start to break out, then that's going to be a sign of definite stability. As far as bonds go, stay away from them. This is the U.S. bond market right here. As you can see, I've pointed out the pre-COVID high. It is below that. Stay away from, really it's all bonds, not just U.S. bonds. I understand if you're over the age of 50, and my money management company works with men and women over the age of 50 because we really understand how things change when you turn 50 and you start going, maybe that over-diversified portfolio isn't going to work for me anymore. And here's a great example where bonds aren't working anymore, and they stopped working years ago. It gets worse. Here's corporate bonds. Now, this is the pre-COVID high. The Fed came out and said, we may buy corporate bonds. They never did. They never bought corporate bonds. All they had to say was, we may buy. I need you to look at this price chart if you own corporate bonds or if you own any bonds. This is a very scary price chart if you own corporate bonds. This is saying kind of the ride is over. Could it turn around? Could this not be a top? Absolutely. But I just want you to kind of notice here, that's not a double top. That's not a triple top. That's a quadruple top. Will it break through one day? Probably, but just notice it tried to for, what is that, 20 months? It broke down and it is below it. Corporate bonds are to be feigned. Stay away from them, even if you're over the age of 50. So people are not moving into bonds. The question is, where are people moving into? They're actually moving into a lot of places. They're moving into companies that make things that come out of the ground. Here's Freeport Mick. I always just call it Freeport. McMoran. I'm not going to put my glasses on. It's FCX. Look at this. This is gorgeous here. Look at what it's done here. This is moving higher. This is a $70 billion market cap company. It is moving higher. These are base metals, right? These are nickel and steel. It's moving higher. So metals are moving higher. XME is a metals and mining ETF. It looks very similar. It broke out. It came back down, priced it. It's digesting that move. Looks like the digesting is happening right now. So look, metals and miners are going up. Precious metals, they are definitely moving. They have a little overhead resistance here, which some sellers came in. So they're digesting some of those sellers from May of 2021. But I think the big news is gold. I don't want to say the big news, but gold is really working on breaking those old lifetime highs. If we look at intraday, let's just quickly look at intraday here. We can see that gold hit like literally within like $2 of old lifetime highs. So what we know is there's still sellers at the $2,075. The more time it goes up and hits that and doesn't break through, sellers are going to sell their ounces of gold, and eventually there will be no more sellers left. And then if I just super zoom out here, you can really see what's going on with gold. I said for a very long time, gold has to stay above $1,800. It has to stay above $1,800. And if it stays above $1,800, and this is a very, very solid play to be in gold as long as it stays, because it's consolidating now at a price that it could never stay above before. Now, this is gold priced in dollars. If you look at gold priced in euros or pounds, or almost any other currency, it is clearly in a bull market. And it's just because of the strength of the dollar that gold in US dollars looks like this. But this is what we have right now for gold. It's also consolidating above its old lifetime high in 2011. But what I want you to really just hear from me is commodities are working. Commodities are moving higher. Let's look at GSG, which is a symbol that tracks. Let's go back to a more zoomed in. So this is GSG. It tracks a commodity index. Yes, you see the war start there. What I want you to get most from this is that the trend hasn't changed. Nothing changed in the trend. It spiked, came back down, and it's still keeping its trend. So yes, the spike happened, but the trend hasn't changed. So money is still flowing into commodities. Money was flowing into commodities before you ever heard the name Volodymyr. And now I'm okay if you guys correct me. What I understand is Volodymyr and Vladimir are the same name. It's kind of like Miguel and Michael. So you have Volodymyr versus Vladimir. This trend in commodities was happening before you ever knew the leader of Ukraine. So this is intact. It's moving forward. Now what we're seeing commodities hit lifetime highs. So gas hit a new lifetime high right here. And sellers came in. Nothing too crazy. This is what you see. Sellers come in at new lifetime highs. And eventually, if it's strong enough, the sellers go away and buyers come in. So this is why we're seeing a correction. You see gas right now at old lifetime highs. Sellers came in. You're going to see this with, let's just look at West Texas Intermediate crude. The same thing happened, but just a little bit lower here, right around $105 a barrel. Sellers came in. Would not surprise me if we had $200 a barrel oil. I don't know when. Is it going to happen next week? Probably not. But this trend, this was the clean out here. And it looks very likely that oil is going to want to go back up to that 140 a barrel to see how things are doing. Okay, so we have that. So yeah, interest rates are going to get risen by the Fed. They will probably raise it from 0 to 1.75%. that could push us into recession. You're going to want to have an approach. You're going to want to have a strategy that knows how to step out of the market, that can keep things very simple, that if commodities are the asset class to be in for the following decade, not for the following decade, but for the rest of this decade, for the next 9 years, you want a strategy that allows you to buy those. What you don't want to be stuck in is an over-diversified 60-40, where you have 75 equity positions and 35 bond positions, and you basically underperform the market and take the full hit. So there's a lot going on. I think China is in trouble. I think people are going to start turning their backs to China and start acting much more aggressive in a good way towards them. Like, please stop stealing our intellectual property. China is absolutely turning into North Korea, which is super sad for Russians. But this is the place we're at. So let me land the plane and kind of wrap things up here. From an equities point of view, from a stock market point of view, buyers have come in at pre-COVID highs. That's the first round. I expect those prices to be tested again. The market is still getting more unstable and not more stable. But for right now, we do have a short-term bottom in, which can mean the market just goes sideways the rest of the year, up and down, which is going to be really bad for traders. Or if you are a trader, you have to be a really short-term trader. Or if you're a trader, go trade metals and mining and commodities, because that's where the movement is. That's where money is coming into. And I think probably lastly is bonds are a place to be avoided. Even if you're 50, 60, 70 years old, they are falling. This is the worst start to a year for bonds, I believe, ever. That's not a good sign. Bonds stopped going up in August of 2020. That is a long time ago. The Fed is not going to be buying corporates. They never bought corporate bonds. And we can see that in the price charts I showed, that corporates are falling. So please let me know where I got it right, where I got it wrong. I appreciate when you guys do correct me on things that I'm mispronouncing. I do that a lot. Part of it is my dyslexic brain. So thank you for that. And let me know what I missed. Let me know what I should put more time on. I know some of you have asked about bonds and what are going on with those. So hopefully I've answered that. And please leave a comment. Please like, please subscribe. All those things help the algorithms and help grow my channel. Thanks for being in my world. And if you like this video, you'll absolutely love our other videos. Okay, thanks. I'll speak to you soon.